Revenue recognition shouldn't be a nightmare, but for many companies, it is. Manual errors, compliance risks, and last-minute fire drills are costing you time, money, and credibility. What if you could turn chaos into clarity? In this video, we'll expose the 5 biggest revenue recognition mistakes and show you exactly how to fix them. Stick around, because by the end, you'll know how to streamline your process, avoid audits, and close faster than ever. Revenue recognition shouldn't be a maze of guesswork, last-minute adjustments, and audit nightmares. Yet, many companies struggle with convoluted accounting rules, manual processes, and inconsistent interpretations of standards like ASC 606 or IFRS 15. The difference between frustration and efficiency comes down to one critical choice: sticking with outdated, ineffective methods or adopting smarter, streamlined approaches. The cost of getting revenue recognition wrong is steep compliance failures, revenue leakage, wasted time, and damaged stakeholder trust. But when done right, it becomes a competitive advantage: faster closes, accurate forecasting, and seamless audits. So, how do you shift from chaos to clarity? In this video, we expose common mistakes that hold companies back and reveal proven solutions that turn complexity into efficiency. Comparison 1. Manual spreadsheets versus automated revenue recognition. Wrong way. Relying on error-prone spreadsheets. Many finance teams still track revenue recognition in Excel, manually updating formulas, copying data across sheets, and struggling with version control. This approach is slow, risky, and unscalable. Consequences. Errors multiply: misapplied rules, incorrect allocations, audit headaches, no clear audit trail, hard to verify calculations, wasted time, endless reconciliations, delayed reporting. Right way. Automating with revenue recognition software. Modern AI-driven revenue recognition platforms automate calculations, enforce compliance, and sync with CRMs, ERP systems. Why it works. Real-time accuracy rules are pre-programmed, reducing human error. Audit-ready full documentation and change tracking. Scalability handles complex contracts, renewals, and modifications effortlessly. Example: a SaaS company using spreadsheets took 2 weeks to close each month. After automation, they cut it to 2 days, while eliminating allocation errors. Takeaway: ditch spreadsheets for automation. Your team and auditors will thank you. Comparison number 2. Reactive adjustments versus proactive policy design. Wrong way. Making revenue decisions ad hoc. Some companies treat revenue recognition as an afterthought, applying rules inconsistently or waiting until audits force corrections. Consequences. Inconsistent reporting, different interpretations across teams. Last-minute fire drills, quarter-end surprises. Compliance risks, failed audits, restatements. Right way. Establishing clear revenue policies upfront. Define standardized revenue recognition policies aligned with ASC 606, IFRS 15, and train team sales, finance, legal to apply them uniformly. Why it works. Eliminates guesswork, everyone follows the same rules. Reduces rework, contracts are structured correctly from the start. Builds trust, investors and auditors see consistency. Example: a manufacturing firm previously reclassified revenue annually due to poor contract structuring. After implementing a centralized policy, they eliminated adjustments and sped up reporting by 40%. Takeaway: don't react, plan. A strong policy framework prevents costly fixes later. Comparison number 3. Siloed teams versus cross-functional alignment. Wrong way. Finance works in isolation. When finance handles revenue recognition separately from sales, legal, and operations, misalignments happen. Sales may sign non-compliant contracts. Legal may draft terms that complicate revenue allocation. Consequences. Contract mismatches, unclear performance obligations. Revenue delays, renegotiations needed post-signing. Frustration, finance constantly correcting others' mistakes. Right way. Collaborative revenue governance. Create a cross-functional revenue council: finance, sales, legal, RevOps to review deals, align on standards, and flag issues early. Why it works. Cleaner contracts: sales understands revenue implications. Faster approvals, no back and forth on non-compliant terms. Better forecasting finance has full visibility into pipeline. Example, a tech startup reduced contract revisions by 70% after holding quarterly revenue alignment workshops with sales. Takeaway: break down silos. Revenue recognition is a team sport. Comparison number 4, ignoring variable consideration versus modeling it proactively. Wrong way: treating variable revenue as an afterthought. Discounts, rebates, bonuses, and performance incentives create variable consideration, but many companies either ignore it or estimate it poorly. Consequences: overstated revenue leading to restatements. Cash flow surprises, unexpected payouts hurt margins. Regulatory scrutiny, aggressive recognition triggers audits. Right way: systematically estimating and tracking variables. Use historical data, probability-weighted models, and conservative thresholds to account for variables upfront. Why it works: more accurate forecasts. Revenue reflects true earnings. Lower compliance risk meets ASC 600 and SAXS, most likely amount rule. Better negotiations. Sales understands true deal economics. Example, a retail company reduced quarterly adjustments by 90% after implementing a discount tracking dashboard. Takeaway: don't guess, model. Variable revenue should be predictable, not a gamble. Comparison number 5, annual reviews versus continuous monitoring. Wrong way: only checking revenue at quarter end. Some companies treat revenue recognition as a periodic event, scrambling to fix issues during close. Consequences: late discoveries, errors caught too late to fix easily. Stressful closes, team burnout from last-minute corrections. Poor decision-making, leadership acts on outdated data. Right way: real-time revenue analytics. Deploy dashboards and automated alerts to monitor revenue trends, exceptions, and compliance gaps continuously. Why it works: early issue detection, fix problems before they snowball. Smoother closes, no surprises at month end. Strategic agility, real-time insights drive better decisions. Example, a healthcare SaaS firm cut month-end close time in half by using automated anomaly detection. Takeaway: stop waiting, monitor. Real-time revenue tracking is a game changer. It's time to streamline. Revenue recognition doesn't have to be painful. The difference between struggle and success lies in rejecting outdated habits and embracing modern best practices. Your next steps: audit your current process. Where are the bottlenecks? Prioritize automation. What can you take off manual spreadsheets? Align teams. Are sales, legal, and finance on the same page? Implement continuous monitoring. Can you spot issues before they escalate? The companies winning at revenue recognition aren't just compliant, they're efficient, accurate, and strategic. Will you stay stuck in the past or streamline your way to success? Start today. The sooner you fix these gaps, the faster you'll unlock smoother closes, stronger compliance, and more reliable revenue. Revenue recognition doesn't have to be painful. Ditch the old habits, adopt these smarter strategies, and watch your efficiency and confidence soar. Ready to take action? Hit like if you found this helpful, subscribe for more expert breakdowns, and drop a comment below. What's your biggest revenue recognition challenge? Let's fix it together.